Good evening, everybody. It's an honor and a pleasure to be here. Always considering my interest in valuation, always ready to speak on the subject. And given Taxmann's wide reach, it's an absolute pleasure to speak in front of you. So I've already been introduced, right? I practice as a professional valuer. That's what I do for my living primarily, and work with hundreds of organizations, especially startups, as well as large listed organizations around the valuation space. So over the next 1 hour, we will talk about valuation of startups. Like you've been already told that if you have any questions, please feel free to put those questions in the chat window. I think I'll be speaking for the entire 1 hour, but what I'm going to do is from time to time, I'm going to check the chat window and see if there are any questions. Whatever questions are there, I will try to address them as much as we can. So when we talk about valuation of startups, right, let's start with the brief story. I'm sure everybody here uses WhatsApp. I always try to take the WhatsApp story because this is something that we can all relate to, right? I'm sure you're familiar that WhatsApp was created by a couple of co-founders, but ultimately it was acquired by Facebook, right? Now in 2013, Facebook acquired WhatsApp for a valuation of about $17 billion. Now, this $17 billion was provided through a mix of cash and shares of Facebook. So initially, when the deal was announced, the valuation was about $19 billion. But since immediately after the deal was announced, Facebook share price came down. And since it was told that these many number of shares of Facebook would be given, the valuation came down to about 17 billion. But that's still a good number, right? Now, here are some matrices for you. Now, this $17 billion, right, is the value of of that acquisition. But what goes behind that value? There would be some numbers, right? I'm sure most of you who are interested in valuation, you understand that there are quite a lot of numbers that go behind any valuation exercise. So these are three broad matrices for you. At the time of acquisition in 2013, the company had 450 million active users. Now that's the uh, value driver for a company which runs a chat window, right, or a chat app. The company had a revenue of only 10 million US dollars, mind you. Okay, 10 million US dollars. Now, what was WhatsApp's revenue model? It said that it's free for the first year, and then it's going to charge $1 per user per year, right? Now, 450 million users and only $10 million dollars of revenue means that out of 450 million users, only 10 million users were apparently paying. And despite that, the company had a loss of $138 million, right? Now, if you look at these numbers, right, I'm sure you know that a billion has got, I mean, a billion is 1,000 million, right? So imagine the differentiation between revenue and the valuation, right? It is 1,700 times the revenue. Now, if you try to crunch some numbers, imagine that this 17 billion, what's the population of this planet? Even today, the population of this planet is only $7.3 billion, 7.3 billion people, right? That's our population. So even if WhatsApp could have generated $1 from every person on the planet, it would not even be able to generate $17 billion of revenue, right? Forget about valuation. So it's a very, very surprising number that everyone came across. Now, there's another anecdote that goes along with this, that just about a year before WhatsApp was actually acquired by Facebook, Google had bid to acquire WhatsApp for $1 billion, right? And that is where the startling fact begins, right? That if Google was willing to buy WhatsApp for $1 billion, why is it that Facebook acquired the same company for $17 billion? Now, if valuation was a right or a wrong exercise, either Google doesn't know valuation or WhatsApp does, or Facebook doesn't know valuation, right? But here's another thing that we got to know. Because Facebook is a listed organization and they have to report a lot of details around their acquisitions, Facebook reported that the valuation of WhatsApp was $1.8 billion, right? The goodwill of WhatsApp was about 15.2. Sorry, this is an error here. This was $15.2 billion of goodwill. Now, for those of you who understand mergers and acquisitions and business combination, goodwill is the amount that is paid over and above the fair value of an acquisition, right? So WhatsApp had an additional benefit. Facebook had an additional benefit that it felt it would derive from the WhatsApp acquisition purely out of synergies, because Facebook would be using WhatsApp, not because WhatsApp was having a standalone valuation of $17 billion, right? So whenever we get into valuation game, and especially when we're talking about valuation of startups, we're talking in this small example, we get to know about two different things, two important things around valuation. One, that valuations can be completely different from and it can definitely beat your intuition, right? Between $10 million of revenue and $17 billion of acquisition value. And second, of course, a lot of times these transactions happen because we are talking about startups, and startups primarily operate in the private market space. A lot of transaction values that you see are actually specific to that transaction and not necessarily fair value from a market participant's perspective, right? I'm sure you must have heard about recent news around Byju's, right? And a lot of people are saying that Byju's had reached a valuation of 22 billion US dollars. The latest valuation that was reported by the investors of Byju's was about $2 billion. And now Byju's has come up with a rights issue at a valuation of $220 million, right? Now, once again, as a personal opinion, right, this $220 million of rights issue is definitely not a fair value. Because again, if you understand business, you understand that rights issue is primarily done only to the existing shareholders. And rights issue by definition is done at a huge discount to the fair market value, right? So 225 million of valuation for Byju's is not representative of its fair value. We don't know what the fair value of Byju's is today, but it shouldn't be as low as it appears based on that rights issue, right? So we've discussed two stories at the beginning, right? Now, what is a startup? There are some characteristics of any startup. These characteristics involve that it should be involved, engaged into innovation, it should have creativity, and it entails a lot of risk, right? Now let's understand the definition of a startup. Is there a definition of startup, right? Practically, there's no definition of startup. There are various countries out there. Those G20 countries are there who are trying to define startups now. But in India, there exists a definition of startup. And that definition of startup is primarily given by the Ministry of Commerce and Industry, Department of Industrial Policy and Promotion, which is DIPP, right? And this definition of startup says that an entity shall be considered as a startup if it is up to 10 years old. So if you're more than 10 years old, you will not be treated as a startup. You should be a private company or a partnership firm or an LLP, that is a limited liability partnership. Your turnover should be less than 100 crores in any years, in the first 10 years, that is. You should be working towards innovation, development, or improvement of products or processes or services. And you should be engaged into a scalable business model with a high potential of employment generation or wealth creation, right? And then there's an additional point which says that you should not have been an outcome of a restructuring. So there was an existing company, you did a merger or you did a demerger and you formed a new organization and now you call it a startup. No, you won't be called a startup. It should be a fresh start by all means, right? Interestingly, SEBI has adopted the same definition under the alternate investment fund regulations. Interestingly, income tax department is using the same definition for tax breaks. There's a lot of incentives that is available for startups today. For example, in the first 10 years of operations, for any 3 years, if you're profitable, you will get a tax holiday, right? There are some additional benefits that is available for startups. But let's understand, is Zomato a startup today? Yes, we can call it a startup today. But Zomato is a listed company now. It's been operating for more than 10 years now. Its turnover is more than 100 crores, right? So if you look at this definition of startup, a Zomato would not fall into the definition of a startup, right? So we are talking about this definition purely from a regulatory standpoint that, hey, if you need a tax break, these are the conditions that you need to fulfill. So let's break the ice. This is not the definition of a startup, right? This is not the understanding of the startup. A startup is something that would be engaged into innovation, development, right? Improvement of products or processes. So these two bullet points primarily define what a startup is. Practically speaking, even Google is a startup today, but of course, it's much bigger an organization now, right? So this is only the legal definition, right? Practically speaking, any company that's constantly innovating, pivoting is practically a startup, not just a new company that's doing something different. Now, again, we see a lot of companies coming up The entrepreneurship has taken a big boom in India, right, and outside as well. And we see a lot of people coming up with new ideas. Now, just because a person has started a new business doesn't mean that it would qualify for the definition of a startup. And when we went into these previous points, right, working towards innovation and development, these are actually subjective points. So depending on who you are and what you do, you would need to apply a lot of judgment to define whether it's a startup or not, right? And that judgment is going to come from your expertise and business understanding. Now, when we talk about valuation of startups, and we'll do a lot of discussion around it, considering the time frame that we have, right? There are some typical things about startups. One, startup is usually a new organization, so you would see that these are young and less mature organizations. They have less number of employees, right? They have less number of assets. They have minimum capital. In terms of size, they would be smaller in size. They would have higher levels of risk. They would have limited access to capital markets, right? And it calls for a small size discount, which we'll talk about. Then there is almost always going to be an overlap in terms of shareholder and management. The shareholders and the management are usually the same. Now there is a positive side to it, and then there's a negative side to it. The positive side is that there is no agency problem, right? The people who are running the companies are the ones who are the owners of the organization as well, right? So in a large organization, you would feel that you are, let's say, the shareholder of Reliance. Now you might be worried whether the management of Reliance is doing justice to you or not. That problem is less in case of startups. But again, right, at the end of the day, the startups are raising funds from investors. So when there are investors on board, then that agency problem begins. The biggest typicality about startups is the quality of financial information. This is a very, very important area. And if you are interested in valuation, this is an area which must be carefully assessed when you are doing that valuation. That is, you do not have a long history of that startup because it's a new organization. You can't go back in time and see how the company has fared in the past. There is going to be limited history. Second, because of lack of reliable data, I'm sure many of you might have heard about stories that there's this company which went into Shark Tank, but ultimately the investors did not pay money to the company. Now see, uh, somebody came and gave a 15-minute pitch or a 30-minute pitch or a 1 hour pitch and mentioned a lot of stories, right? That this is what my business model is, this is my revenue, these are my investors, etc., etc. And on national television, there are a bunch of investors who have said that, yes, I'm going to invest in your business. But who knows whether that story is true or not, right? So after that discussion happens, there is a process called due diligence, which needs to be performed. And in that due diligence, which could be a financial due diligence, an operational due diligence, a commercial due diligence, and a legal due diligence, those facts which was those statements which were made on television or during the pitch have to be vetted and confirmed. And if these are not found to be true, of course the investors is not going to put money, right? So that reliability of data is also a very important factor. Then there is lower history. A lot of discretionary spends coming. Think about it. You started a business, right? And you have been running that business for, let's say, the last 4 years. Now, in the last 4 years, as a startup founder, you have not taken any salary. But in your last organization, you were drawing an annual salary of 50 lakh rupees. Now, when you're valuing a company from a market participant perspective, isn't the company using a resource worth 50 lakh rupees in a year? The company is. But as a startup founder, you are not drawing any salary. So when you are valuing that organization, don't you think that if the company is profitable, that profit is overstated by 50 lakh rupees? Or if the company is into a loss, that loss would have been more. There would have been a bigger loss by 50 lakh rupees because the company is using a resource, right? So on the other hand, when the company starts getting funds, right, there may be founders who are drawing whatever salary they want. I could be, as a startup founder, I could be drawing 5 lakh rupees a month or 10 lakh rupees a month. Who's asking me? So we call these as discretionary spends, right? These spends are amounts, or I could be charging my personal expense to the company as well. Because of these factors, the financial statements are often less reliable. And therefore, as a valuer, we need to assess whether these numbers make sense or not, right? So The quality of financial information is often the most important factor when we are getting into the numbers of startups, right? One of the most important factors. Then what kind of life cycle the company would be, right? Even within the startup, there could be different life cycle stages. So one would be an early stage, which is at the very, very conceptual stage, right? So the company, the earliest stages of development would be valued using the asset-based approach. So think about it. When we talk about what is an asset-based approach, right? So let's say I'm trying to create an app which will allow me to chat with the other person, right? Now, today, if I have to create an app like this, which has chat features, it would not take much money for me, right? I can develop that app in 5 lakh rupees, 10 lakh rupees, 15 lakh rupees, 20 lakh rupees, right? Not more than that. So just because I've developed this, am I entitled to get crores of rupees of valuation? Something that we need to be very, very careful about, right? So oftentimes we see that there are founders who are coming and asking for valuations, and these valuations are purely based on a PowerPoint slide, right? An Excel, a bunch of Excel spreadsheets where it's all castles in the air, right? So we have to be very careful that, hey, this is easily replicable. So until and unless you've established a product market fit, I'm not going to pay you a premium. Therefore, I will only compensate you for the amount of money that you have already spent into the organization, right? So the future cash flows may be too unpredictable, and there is no guarantee that the company will be able to operate in the long run. So therefore, here we will compensate for the amount of money that has been spent. Now, the moment there is a product market fit which has been established, right? Meaning the company has already created the product has is gaining traction. You have started selling the product, and the product has started gaining traction. That's when we would try to value the company using the income approach, where I have some history coming in. We'll go into more details around, right? And we will still to take a bet on whether the company will be successful or not, right? You understand that it's easier to generate 1 lakh rupees of revenue than to generate a crore rupees of revenue, right? And as you scale from 1 crore to 10 crore and from 10 crore to 100 crore, right, your difficulty keeps on increasing because your base becomes higher, and therefore it becomes more and more difficult, right? So we will take a bet whether this is feasible or not, right? Whether it will survive in the future or not. Then we have matured startups where the company has started generating revenue. It is reaching EBITDA positivity, right? That's when we'll start using both the market approach, because by then competitors would have started coming in, right? And company would have some history as well. We will use the income approach to valuation. So why do startups fail, right? Because we talked about whether the company will succeed in the long run or not. So there are various reasons, and these reasons also have to be assessed very carefully. A lot of qualitative factors would go into valuation. It includes lack of persistence, which is the startups quit too early, right? So for example, there's a thumb rule which says that you need to survive for 999 days, basically about 3 years. If you've survived for 3 years, that means the probability of you succeeding keeps on increasing. But a lot of people shut their shop in about a year or 6 months time, saying that, hey, we've tried, but it isn't working. Then this poor corporate governance, we just spoke about some of the corporate governance factors, for example, discretionary spends, charging personal expenses, right? And so on. Then, of course, resources is a key factor why startups fail. So they run out of money or out of resources, right? Scaling becomes a problem, and so on. A lot of time people underestimate their competition. I have started my business. I will always be clouded by the amount of value that I can generate, right? I would feel that this is the best business. And we often see that founders tend to kind of defend their startups in such a manner that, hey, I know the competition is not going to catch up with me. But hey, let's face it, the competition is there to catch up with you. Okay. So underestimating competition is a very important factor why startups fail. Then sometimes they're too slow to pick up, right? And there is late execution, and there is fear of taking risks. So as we discussed in our earlier slides, that a startup is about taking risk, right? So you need to pivot, and that's what the next bullet also says: not adaptable to market needs. That is, they are not able to pivot. So as the market reacts to your product, a startup would need to react accordingly. They will have to keep trying new things. Hey, this will work or this will not work, right? And we've seen a lot of our startup clients who've done a lot of good things, right? So for example, if I have to start a new feature in my app, I will try to roll out that feature in a small market and see where's the response coming. What kind of response are we getting? I don't have to roll out everything in the national market, right? I will take measured approaches and then I'll go ahead. The other problem that we also see is that startups try to spread themselves too thin. So I've launched an app and I feel that an app can be accessed by anybody in the country. So I do a national launch, right? But behind that app, I need to deliver something, right? It could be a product delivery, it could be sending golgappes, or it could be selling clothes or whatever, right? And that requires a very strong supply chain system. So I have started marketing my app across the country, but my supply chain is not strong enough, right? So I am going to fail for sure. So those are some of the reasons why most startups fail. Of course, there are various others. So when we try to value a startup, we try to understand that, because these startups are about stories and negotiations, and we're going to talk about that as well. So whenever we have to understand a startup, the founders will tell us about their business, right? And they will say, we can do this, we can do that. So every valuation is going to be based on a story, but we need to ensure that we don't fall for the VFXs, right? We need to understand the gravity. We need to understand the realistic situation of the business. And of course, we will be wrong most of the times, but we often go by our gut as well, right? So, for example, we have to understand where is going to be the future of this company. So, if we see that the company may not survive in the long run, I will apply a probability of default. So, I say, okay, based on your projections, based on your story, this is the value that you are seeing. But what if I don't reach year three, right? What if I have to shut shop in year two or in year one? So I will apply a probability of default for the long run, right? It could be for year one, year two, year three, and so on. We'll take examples of all of these. Or if the company will survive and scale despite the competition, it can again do two things, right? It will scale on its own, where I will apply the perpetual cash flows in the terminal value. TV is terminal value. I will say, okay, the company is going to operate on its own and it's going to have its own cash flows coming in. But a lot of times we also see that the startups get acquired by competition. So as long as you're a good startup, it's still a good revenue, it's still a good payback to get acquired by a large competitor. So there we see what kind of exit multiple can be applied. And again, we'll talk about what is an exit multiple, what is a perpetual cash flows, and so on and so forth. Okay. So let me take a quick pause and see if there are any questions. If you have any questions, please feel free to post it in the chat window. Would be happy to take it. I see a chat window here where there was one message. Good evening, ma'am. I don't know if that's the chat window where I'm expecting questions or it's somewhere else. Right? It's going fine. I should proceed. What's the exit multiple as per industry practice? So exit multiple would vary according to industries. So when we say exit multiple, we are talking about any multiple that is applicable to any industry today. So for example, you've heard of the Sensex is trading at about 38 PE multiple, right? So that's a PE multiple for Sensex, right? A price earnings multiple for a banking industry or a manufacturing industry or a trading industry would be different, right? So there's going to be an enterprise value to EBITDA multiple or price to sales multiple or price earnings multiple. So these vary according to industries, right? For example, most companies trade at a price to book value multiple of about 2.5 to 3x, but those are matured companies. So we are assuming that these companies will mature over the next 5-year period. So we would look at those kind of multiples. Again, Aditi ji, I think it's going to vary according to the industry that we are in. So there can be different types of apps, right? And I cannot assign a number right away. No, I've seen temperature concurrence. So now, if you look at the life cycle of the organization, if we divide the life cycle into various stages, let's see what the situation is, right? So when we're talking about product revenue, so stage 1, 2, 3 would have no revenue at all. Stage 4, you will get some revenue. Stage 5, you will have growing revenues. And stage 6, you would have established history. So this is the matured stage, right? This is where the company ceases to be a startup. It becomes a matured organization, right? Expense history would be limited, and from then onwards, it's going to be substantive. Profitability, you would most likely see losses in the first 4 stages, and then you will see a break even, and then you will have an established history of profitability. Management team would keep on expanding till the first couple of stages, and then you will see these are complete. Product development would be limited in stage 1. It will be underway in stage 2, right? So if you see the first 3 stages, we are trying to establish the product market fit, and that's why you don't have revenues in the first 3 stages, right? From 4 onwards, you will start fulfilling the orders, and then you will have an ongoing product development. Financing sources, stage 1, you would normally see angels and or early venture capitalists. Stage 2, you will have venture capitalists. Stage 3, you will see venture capitalists and strategic investors. Stage 4 could be mezzanine finance or strategics. Then stage 5, you could see an IPO, right? Or it could come in stage 6. And then you will have self-funding stroke debt plus equity. Self-funding meaning you are plowing back your profits because you have an established history of profitability by then. Right? So you'll have different kinds of stages in startups. Right? This kind of shows matrices around risk and investment and sales and profitability, right? So if you see at the ideation stage, the risk is very high. But as the company expands, the risk level starts going down. At the same time, when you see investments at the ideation stage, it's very low. But as the company expands, the investment starts to mature. Okay. Sales are going to be very, very low at this stage. And therefore, you will see in the growth phase, the sales is going very high. And then, of course, the sales will stabilize at a normal level. The last one is profit. And if we say that this is our zero axis, right? You would not see profits in the first couple of stages. It's only when you're at the growth stage, you will kind of see a break even. Okay. And then when you're expanding, your profits will start going up, right? So, and who are the kind of investors who are coming in? So here, like I said, you will have angels, right? You will have VCs here, right? You will have strategics or VCs here, PVC, strategic, and then you would look at an IPO kind of a situation here, kind of investors who will find comfort. Now, when we enter into valuation, and a lot of times people tend to believe that valuation is only going to be a numbers exercise. Trust me, my professional colleagues, valuation is going to be 80% subjective, 20% objective. That's why I haven't even gotten into the numbers yet, right? And that's primarily because 80% of the valuation exercise is going to be subjective. So what are some of the things that we look at in any evaluation exercise? We're going to look at the competition. So what are the barriers to entry? What is a sustainable differentiation? Whether it's a crowded space or a market erosion, right? So what kind of competition do you see? For example, if tomorrow somebody says that I'm going to sell golgappas across the country, or I'm going to deliver food across the country, today the barriers to entry in that business is very, very low. So even if you have a very disruptive model, right, it's very unlikely that you will get a very high premium for that until and unless you have proven and reached that stage. And we do know there are companies like Blinkit or Swiggy or Zomato who've done that. But imagine the kind of time that they have taken to do it. Now, if today somebody enters that industry is already at a matured level, right? Very, very difficult to break the ice there. Similarly, if somebody enters into an edtech industry now, we know the kind of problems the edtech industry is facing. But on the other hand, if you look at a health tech business, for example, again, the barriers to entry is low, but there is so much in the health tech industry. Now, the problem with health tech industry is that normal people, B2C, I mean, health tech industry hasn't really reached the B2C level yet. It is still operating at a B2B level. So in my personal view, there is still a lot of room for the health tech business to grow. Although we are constantly seeing a lot of startups continue to come in the health tech space. Similarly, when we're looking at a fintech industry, we've seen the kind of problems that fintech has had. But surprisingly, fintech companies continue to get a lot of funding, a lot of valuation, as long as they are disrupting, because it operates both in the B2B as well as in the B2C space. So you need to understand what is the total addressable market. TAM stands for total addressable market, right? It talks about the size of the market, the growth of the market, macro trends, measure of consumer intent, and so on. And then there's competition. So you focus on these factors, understand what the business is going to achieve, or what you are going to achieve as an investor, and then move ahead. Then when we're looking at the business, we look at whether the business is scalable or not. Again, it will flow from the market. It will flow from your competitiveness. You look at business model, whether it's a recurring revenue or a one-time revenue, right? I mean, think about what happened in case of Byju's, and we will have only limited discussion around it. When Byju's is selling its service, right, it is selling two things. One, it is selling content, which a class 6 student will use in class 6, a class 7 student will use in class 7. But in order to protect the content from being copied, and for a lot of other reasons, some strategic, some investor pressure, etc., it also started selling devices. Now, if a class 6 student is buying content and that content comes in a specific device, if I'm moving to class 7, I will not be buying the device again. I will only be using the content. I will be renewing the content for class 7. So my revenue if I'm Byju's, my revenue is split into non-recurring revenue, which is a device which a user will use only once in his lifetime, and a recurring revenue which I will be using year over year. Correct? So one needs to understand, if I'm only looking at the top line, which is revenue, I need to understand the breakup of that revenue. Correct? Then there's shorter sales cycle, large value proposition. So what kind of business model you have, what kind of growth you are getting in terms of traction, right? How are you using your funds? And one of the most important things in the financials we see is contribution. Think about it. What is contribution? Contribution is sales minus the variable cost, right? Now think about it. Variable cost is what? Whenever we are selling something, what is so for example, if I am a Blinkit, right? Every time I have to fulfill an order, I have to incur some transportation cost. That is a delivery cost. Now, this delivery cost is a variable cost, right? When you're ordering something on Blinkit, there is something called a delivery charge that they take. Now, think about it. It could be a very small amount. It could be 20 rupees. But the company needs to ensure that this 20 rupees must recover the cost of delivery for Blinkit. If it is not recovering that cost of delivery, more orders it fulfill, the more losses it will incur. And it will be very difficult for that company to overcome that loss over a longer period of time. So you must have positive contribution. Now we have CM1, CM2, CM3. We're not going into that. But contribution is variable cost. Sales minus the variable cost. So you must have positive contribution. Then you also look at previous rounds of funds, right? Past evaluation, dilution. Also, if I'm looking at the team, right, I cannot have a startup who's trying to raise funds or get a strong valuation when the founders are not full-time workers on the team. If I'm running a company which has a huge dependence on technology, I cannot outsource that technology. I need to have an in-house tech team. I need to have an in-house tech founder. If I don't have that, I'm not going to get good valuation, right? Because it's going to be questionable. So how do early stage companies get their valuations? It is early, and mind you, my key point is early stage companies, right? It's a function of two things, story and negotiation. So one, what is the story? And we've already spoken of, you should not fall for the VFXs, right? What is the story? What is the perspective of the founder? What are they going to do? Because the companies are going to pivot a lot, right? So how are they going to navigate through competition? How are they going to scale their growth path? One. And second, and this is a very important aspect because now we are getting into numbers, right? Valuation is a function of negotiation. At early stage companies, you cannot value an organization because valuation, we say that, of course, it's demand supply driven, but at the same time, it's a function of what you are going to achieve. And nobody knows what you are going to achieve, right? We don't know about the survival. We don't know about the pivoting. We don't know about your expected revenues, right? We don't know about your profitability. So therefore, those bets are taken based on negotiation. And I'm sure many of you who are watching programs like Shark Tank, because that has created a lot of awareness around startups, right? A company comes in with a proposed valuation of 50 crore and ends up taking a valuation of 5 crores, right? Purely out of negotiation. So that's why we say that in early stage companies, we usually do pricing. We don't do valuation. Of course, whenever we are doing a valuation, it has to be defensible, but these are mostly priced, right? So before I go further, let me take another pause and see if there are any questions. Yes. So I have a question which says, what exactly you mean by terminal value? So terminal value means it is an exit value or a last value. So I will have stages of valuation, right? So terminal value is the value when the business has sort of achieved a maturity stage. From now, it is going to have a normal growth rate. Okay. So think of a company like an ITC, which is a 120-year-old organization, still growing at 15% in terms of revenue, etc. But the company is now largely matured. Correct? So yes, you're right. I mean, in DCF also, we use a 5-year term. After 5 years, we take a terminal value. By the way, in case of startups, whenever we are applying DCF, we tend to take it 10-year period rather than a 5-year period, because in 5 years, the company is not likely to mature in most cases, right? So in terminal value, when I'm taking, let's say, a normal growth rate, it doesn't do justice to the company, right? So I think I've answered that. Second, can we use IPCPL for privately held companies instead of adjusted CPM? Rushi, can you help me with the full form of IPCPL just for the benefit of everybody else? What is IPCPL according to you? Right. Meanwhile, there's another question: how to become a registered valuer in India, which is the certifying authority? Good question. So in India, the registered valuer profession is regulated by Insolvency Bankruptcy Board of India, which is IBBI. In order to become a registered valuer, and as I'm assuming you're talking about a business valuer or a securities and financial assets valuer, you need to have minimum 3 years of experience as a professional. There are about 14, 15 registered valuer organizations. You join those organizations, become a member. There's a 50 hours of training. You undergo that training, even if you're a qualified CA, experienced CA, etc. Right? Then you have to write an exam. Once you pass that exam, you have to take a certificate of practice, which will entitle you to take up engagements as a registered valuer. Okay. So I hope RAA, that's what your name says. I hope you've got it. Again, happy to answer other questions, maybe outside the session if you want. Implied private company pricing line. So yes, you can, right? We don't use implied private company pricing line. We use adjusted CAPM. We also use something called a build-up approach, right? But yes, we've heard of implied private company pricing line. You can, as long as you have reliable data, you can use this as well. Okay. What will be the impact of valuation if due diligence stands deal breaker and valuation numbers are pretty good? See, Vikashji, for any valuation, valuation is one thing, right? It's an understanding of what the number is. And then you are doing, the purpose of valuation is to get a deal or to have an investor on board. So if the due diligence stands deal breaker, there will not be an investment. The valuation numbers can still be pretty good. You might have another investor who might be willing to invest in your company, right? Okay, thank you. Okay, thank you. Yeah. So I'll move on and then we can take other questions as well. Now, this is something that we've designed in-house. This is our way, our model of understanding the premium in case of valuation. So what we do is we evaluate pre-revenue and early stage startups. We see the business, we see the market, we see the team, and then we see, is it solving any major problem? If no, then no major premium would be given to them. If yes, then we move to the next part. Is there a huge scaling opportunity? If no, again, we move towards a no major premium. If yes, we say, are there existing players? And this is where a lot of people say, Vikash, you are not doing the right thing. But that's our experience. Are there existing players? No. We do not give them a premium. If yes, right, we say, can it sustain the cash flows and high margins? And let me explain why. Because a business will command a premium only when there are competitors as well, right? The first mover usually doesn't get a high valuation. It's the second mover who gets a high valuation. Remember this. Facebook is the largest social media company in the world, not the first one. Amazon is the largest e-commerce company in the world, not the first one, right? Think of all the business. Airbnb, largest hotel aggregator in the world, not the first one. right? So think of all the companies who are the top companies, right? In majority of the cases, you will see that it's the second player, the third player, a subsequent player who got a high valuation, sustainability, usually not the first ones, right? So that's our experience. Now, then we say, can it sustain the cash flows and high margins? No. Again, we go towards a lower premium. If yes, then we take a major valuation premium. How do we value them? We use benchmarking multiples and we use a lower discount rate with lower probability of default using the income approach, right? In case of no major premium, we will incline more towards the cost approach. If we are applying the income approach, we will apply a high probability of default. So that's a framework that we use internally at Omnifin whenever we are valuing a startup. Now, based on some of the questions that I'm getting, I'm assuming that a lot of you or many of you understand valuation concepts a little bit, right? So just to tell you a quick overview, there are broadly three approaches to valuation. Traditionally, we look at the market approach where we take the multiples or the recent investment values, right? If I have to value Reliance Industries, I can simply go to the market and find its market price rather than doing any other method, right? That would be my first understanding of the valuation. I can take multiples where when we say multiples, it could be like a PE multiple, it could be a price to book value multiple, right? It could be EV by EBITDA multiple and so on. So I will take those multiples as valuations, but those are traditional methods. In startups, we also use something called a price of recent investment. So if there was a funding in the company that happened 4 months ago, and if I'm looking at valuation again, I can rely on the funding that happened 4 months ago and the valuation thereof, right? We'll talk about more approaches. We'll take a couple of examples as well. Then we have the income approach where we apply the discounted cash flow method, better to be used in later stages. Replacement cost approach, we've already discussed. For pre-revenue companies with no breakthrough model is when we apply the traditional valuation methods. Now, some special models have evolved, right? The first one is the venture capital method. Think about it, right? If I'm an investor in a startup and I am not going to be worried about what is happening in the company every 3 months, 6 months, because typically my investment horizon would be a longer period, right? So I am interested in knowing that what's your aim, what's your vision, right? Where do you see yourself 5 years from now? Kind of a question. So we estimate the expected earnings or revenues in a future year, let's say 5 years from now, right? It could be 10 years from now as well, by the way. Okay. So we say, all right, we are burning money right now. We are not incurring profit. We are not earning profits, etc. But in 5 years' time, I'm sure that I'm going to be earning maybe 10 crores of profit or 100 crores of profit, etc. Now, my industry is going to mature, right? So I know what industry I'm operating in. So in that industry, what is the price earnings multiple that is applicable? And it could be forecasted, it could be current, right? I don't know forecasted PE. So I will be using the historical PE as well, or the current price earnings multiple. Now, expected earnings in the 5th year multiplied by the price earnings multiple can give me the equity value at the end of the forecast horizon period, that is 5-year period, right? That is going to be the value 5 years from now. But I am looking at a valuation today. So what I'm going to do is I will look at this value and I will discount it based on my target rate of return, right? So equity value at the end of forecast period, which is 5 years, divided by 1 plus the target rate of return to the power 5. That gives me my equity value today. Okay. If you put yourself into the shoes of a large investor, that's what you would be doing. Okay. So this is called the venture capital method of valuation. Just to give you an indication of what kind of returns, because see, 5 years from now, you don't know what's going to be the number, right? You can do a sensitivity analysis, you can do a probability analysis, etc. But that's still a number that you're not going to get. Okay. PE multiple, you can get it easily. You know what industry you're operating in, what's the price earnings multiple in that industry. Do that calculation, you'll get that number. The question is, what's my target rate of return? How do I assess what return am I expecting? Now, this target rate of return is not going to be a 10%, 15%, 20%. It's usually very high. So the AICPA, right, there are 2 researches that were done. And these researches were quoted in American Institute of Certified Public Accountants, right? They say that these are your required rate of returns expected by venture capitalists for companies in different stages. So if you're a startup company, right, completely ideation stage, your rate of return could be as high as 50 to 70%. When you're in the first stage or early development stage, it could be 40 to 60%. When you're in the expansion stage, it could be 35 to 50%. And when you're in the bridge or IPO stage, it could be 20 to 35%. Okay. 20 to 35%. That would be your discount rate. Okay. And therefore, like I said, when we are doing early stage, right? Because see, I am using a very high discount rate also because I am missing out on a lot of details, right? I'm just looking at a 5-year expected profit. I could be completely wrong there, right? I may not even reach close to, I could be 100% wrong there, right? So therefore, because the numerator is very, very uncertain, I need to build in a very high discount rate to capture the risk of the numerator, right? So that's how these numbers work. And you can imagine that these numbers can give you very, very distorted results. But let's take a quick example. A young edtech company, Om Limited, is expected to go public in 10 years, right? The valuer expects that the net profits 10 years from now will be 95 crore rupees. The average PE multiple is 20x. Om Limited is evaluating fundraising from investors, and investors are expecting 45%. So let's say the investors are somewhere here, right? First stage. So they're expecting 45% from the return until the company goes public. So what is the exit value? And some of you were asking about what's the exit value. So this is the exit value. You can calculate it using free cash flow or using a multiple, right? So my expected profit is 95 crores. My PE multiple is 20. So therefore my exit value becomes 1900 crores. This 1900 is discounted at the rate of 45% for 10 years. I get a valuation of 46 crores. Simple. Okay. So that's venture capital method for you. Yes, it's very, very subjective. These numbers cannot be vetted very easily, right? But that's how valuations can be done. You would use this as a benchmark. You may not use it for transaction purposes. But yes, to get a benchmark number, a ballpark number, you know where to start. Okay. Quickly looking at questions. Okay. Can you check this? Okay. Yes. Okay, I have another Q&A. In case of companies filing DRHP for an IPO, how can we calculate whether the share price band proposed is appropriate or not? You again, so you would do everything that we are discussing in this session and a lot more. Okay. So how do you assess whether the share price band is appropriate or not? You would look at uh, what are the peer companies, what's the number at which they are operating, right? When you look at a lot of these numbers, right, you will get a sense that whether the PE multiple appears to be too high or not, whether the EBITDA multiple appears to be too high or not, whether the growth rate is appropriate or not, what's the history of the promoters, correct? So there are a thousand things that goes into deciding on the price. Everything that we are discussing today needs to be checked. Okay. Then there is another method which is called the Burkus method. We don't apply this in India, to be honest, right? But it tells you that, okay, I can assign up to $500,000 US for a sound idea, up to $500,000 US for a prototype, whether it is created or not. It will reduce the technology risk. $500,000 for reducing execution risk, that is quality management team, right? $500,000 for strategic relationships, and about another $500,000 for product rollout. So these are some methods we don't usually apply. When you get this, I think you will be getting this PPT. You can take a further look at it. This is an interesting example. We thought we should discuss this with you. How do we typically use transaction multiples for valuation, right? So if I'm valuing a company, I will also try to see some of the other companies in the similar industry, what kind of valuations they have got. Okay. So let's say I am valuing P Limited, right? I'm valuing P Limited, and P Limited has seen, you've seen that there are 4 other comparable companies. Okay. These are comparable companies. These comparable companies had transactions in the recent past, 23, 22, 23, 22. Their enterprise values were these. These were the valuations at which that transaction happened. And at the time of that transaction, the revenues were these. Okay. Now, please observe that in case of startups, because the companies are usually not profitable, if at all I have to take a multiple, I can take a revenue multiple. And this is an example for you, but we've done a lot of research, and these multiples can be very, very distorted. I mean, trust me, in our example, we see a 7x and a 10x, but in reality, you could have a 7x and a 70x, and those would all be very common transactions, right? So there's a lot of subjective assessment that you would have to do to arrive at a realistic multiple. But let's say you have these four enterprise value to revenue multiples. You take the average of those. From there, you need to make certain adjustments. So let's say these companies were large organizations, right? Look at this. The revenue was 25, 23, 9, and 12, but my revenue is 15, right? So two of the companies were more than me, right? And two were less than me. That's how I will choose these transactions. So I can take a size factor of 10%. I will add 10% premium to the multiple. These companies have gained some traction, but my company hasn't. So I might take a brand factor and reduce my multiple by 5%. And then I am growing faster than these companies, right? So therefore, I might take a 5% additional high growth factor. So ultimately, what I'll do is I will take 0.9x as an adjustment to the average EV by revenue multiple. Okay. I may not do it. I may do it. It will depend on my comparable companies and my business. Okay. So from 8.6x, I have adjusted my multiple to 9.4x. I multiply this 9.4x with 15.5, that's my revenue. And I get the enterprise value of 145.79 crores. All these are in INR crore, right? That's how I can arrive at a valuation using transaction multiples. It's very common. And of course, you would need a lot of data sources to get these transactional data, right? But yes, when you enter into that space, you will be able to do it. Once again, these multiples or these valuations may be used for benchmarking purposes. Your clients may or may not accept it. But when, let's say, and I'm not going into DCF valuation in this session, but if you have a valuation which you arrived based on, let's say, a discounted cash flow, you should do this exercise to see whether the number appears to be reasonable or not. I'll take one more example. Let's say if you're valuing a pre-revenue company, right? Another example of how you could value using a comparable company. So let's say you are sitting in the year 2014 and you have to value a text messaging company called Chat App, which has got 1.6 million users, but no revenue, right? The company does not report any revenue. Then what will you do? So what we have is, let's say, because we are talking about year 2014, WhatsApp acquisition happened in 2013. So you know that acquisition happened at 19 billion or let's say 17 billion here. But when you looked at the Facebook financial statements, you realize that the value of acquired users was only 2 billion, right? And because because Chat App primarily only has got a user base, right? What I'm going to do is I will take this 2 billion and not the 19 billion or 17 billion as my valuation. I divided by the daily active users of WhatsApp, I get USD $4.5 per user. And I'm sure many of you might be surprised. Anybody who has seen that WhatsApp case before feels that the valuation was about $42, but that was not. We've clarified this today. Around that time, let's say the INR exchange rate, because we are in the year 2014, my exchange rate would not be 83. Let's say my exchange rate was about 70. So my value per daily active user comes to 338 INR, right? Now, because we are still talking about a very high user base here, but I only have a 1.6 million user base, I might take a discount for size. And I can take a 50%, I can take a 90% as well, by the way, okay? Right? This is something that you will have to break down further. But I've only taken a 50% discount rate here, discount to the multiple. So I assign a valuation of 169 rupees per user. I have got 1.6 million users. It can fetch me a valuation of about 27 crores for Chat App, right? That's how we can do that valuation. So once again, quickly, any questions? Because we just have a couple of minutes left. Q&A. In case of companies, acha, we've already answered this, right? Okay. All right. 15.5 crore is for which year? Is it audited per last year or the forecasted year? We'll take the audited number, the latest number. Yes, of course, you can take it forward. You can take a forward revenue as well, but normally we take the current revenue, right? Because if you're taking forward revenue, that means you're talking about a target price. So if you're coming from the stock market context, when they give you a forward when they give you a forward revenue multiplied by the current price, they are telling you a target price, sir. They are not telling you the current price. Okay. So we would take the current revenue. So that, I think that's about it anyway. We are talking about Zomato, right? So one of the companies which has done very good, very well after the IPO, right? So you see, the company came up with an IPO price of about 126. I don't know the exact number, but trades at about 155 right now, right? You look at the revenue from 2019 to 2023, it has really ballooned. But not only the revenue, the company's EBITDA, now of course it is negative, but the negative portion has actually improved, correct? So the company is heading towards earning profits, right? And that's why the companies or the investors are still giving it a thumbs up. Okay. Now, this is something that you need to understand whenever you're valuing a company like Zomato. So look at the business. It is into food delivery business. You would need to evaluate the revenue drivers and cost drivers, which would include the number of monthly transacting users, what's the order frequency, what are the commission rates that the restaurant partners are paying, right? How many restaurant partners are accepting or are subscribing to the delivery ads, right? You would need to track these matrices to see whether Zomato's valuation is going to go up or down, correct? Similarly, when you're looking at the dining business, majority revenue model is advertising. So how many monthly average users does the company has, right? And what are the delivery advertisements? How many restaurant partners are subscribing to the delivery advertisements? Similarly, it also has a hyper pure business where it is talking about number of restaurant partners, order frequency. These are the revenue drivers. And similarly, you have Zomato Pro, which is a subscription based service. You would see what is the membership fee and how many pro members are subscribing to it. So when these matrices move up or down, the valuations are impacted, right? Just to give you some data points, the number of food delivery restaurants in Zomato has gone up from 148,000 in 2021 to 210,000 in 2023, right? 210,000 food delivery restaurants covered in 2023. That's a huge number, right? And average monthly users is up from 6.8 million in 2021 to 17 million in 2023. So you would need to track these numbers to be able to get to a realistic value. So I think that's about it from my side. I need to ensure that we close in time. Again, so cost drivers are direct variable cost, or what drives the cost of the organization, right? So when you look at the revenue as well as the cost drivers, you are ultimately heading towards profitability. So where is the major cost that is being incurred? That's what we are trying to understand here. ये हम लोग कर रहे हैं कि वहां से हो रहा है? अच्छा, वहां से हो रहा है. Okay. Okay, how to find the beta coefficient of any industry? There are various ways of doing it, sir. Beta coefficient, one easiest way is to get it from Damodaran. I mean, he comes up with numbers on a half yearly basis. You can find beta across industry, across countries, but that's only half 2 times in a year. So therefore, we would always want to do our own calculations. You can get beta of different companies using websites like Money Control, Economic Times. Those are free sources again, right? Or you can find it on very premium sources like a Bloomberg or a Thomson Reuters, right? Various companies. We try to do our calculations on our own sometimes. So because when you're getting beta from other sources, you don't know what's the market that they are considering, right? So therefore, we try to do it on our own. We try to calculate using Sensex or a BSE 500 or a BSE small cap, etc., and calculate it using Excel file, right? So you have returns for the stock versus the returns for the market and calculate the slope. So any other questions? Happy to take it. Organizers, I don't know how much time do we have. I'm exceeding by 3 minutes, but happy to take questions if you allow and participants have it. And for those of you who've joined, would be happy to connect with you on LinkedIn. That's my LinkedIn ID. Feel free to connect with me.
Sure, sir. If you think there are further questions, you can address it.
So I didn't find any. There's one question on IPCPL. I don't have a ready data on this, right? So I will have to skip that. But other than that, yes. So can we use DCF for pre-revenue companies based on projected financials? Yes, you can. But again, you need to understand the risks when you are applying that approach, right? I'm definitely you can. DCF is a very robust method, but you would need to be very sure of the potential projections that the company is giving you, right? We also try to do a lot of simulation. We try to apply probability concepts. Like I said, we will apply a probability of default, right? So I will apply a DCF with a cost approach, or I will apply a DCF and vet it using a market approach to see whether my DCF numbers are appropriate or not, right? So yes, definitely you can apply. Okay. I think that's about it. I don't see any other open question. So if you're good, I am good. Thank you very much.